The middle class doesn't get rich, and it's not because they don't work hard. In fact, most middle class families are working harder today than at any point in the last 50 years. They are following the playbook perfectly. They got the good job, they secured the stable income, they signed the 30-year mortgage, and they are diligently contributing to a retirement account. They were promised that this path leads to security, but the data shows something completely different. While the surface looks like success, the underlying numbers reveal a fragile reality. We are witnessing the income illusion, the expense trap, and a retirement myth that is setting millions up for a late life crisis. There is a massive wealth gap forming inside the middle class itself, dividing those who are simply high earners from those who are actually becoming wealthy. By the end of this video, you'll see exactly why most middle class families feel stuck even when they're doing everything right, and you will learn the data-driven shifts required to break the cycle. To understand why the system isn't working, we first have to define what the middle class actually is, and we have to do it with real data, not just feelings. Depending on where you live, being middle class can mean earning anywhere from $45,000 to $150,000 a year. But here is the problem: income is not wealth. You can earn like the middle class and still have almost no real net worth. If you look at the income percentiles versus net worth percentiles, the disparity is shocking. A household might be in the top 20% of earners, but in the bottom 40% of wealth holders. This is because the middle class is defined by their ability to consume, while the wealthy are defined by their ability to own. The data shows that while middle class incomes have stagnated when adjusted for inflation, the cost of the middle class life, education, healthcare, and housing has skyrocketed. This creates a tension where you feel like you're making more money than your parents did, but your lifestyle feels more precarious. The reason for this starts with how money actually flows through a middle class household. The middle class cash flow formula is an invisible system designed to keep you at zero. Think about the path of a dollar earned by a typical professional. It starts with gross income, but before you even see it, taxes take a significant bite. Then comes the largest expense: housing. Following that is transportation, then lifestyle inflation, and finally the service of debt. Whatever is left over, if anything, is considered savings. The fundamental flaw here is that for the middle class, expenses grow at the same rate as or faster than their income. This is why raises don't create wealth. When a middle class worker gets a $10,000 bump in pay, that money is almost immediately absorbed by a newer car, a slightly better apartment, or higher quality groceries. This is known as the two-income trap. Data shows that two-income households today actually have less discretionary income after fixed costs than single-income households did in the 1970s. They're running faster just to stay in the same place. This is where it gets dangerous, because when income stops, even for a month, the entire system collapses because there are no assets producing cash behind the scenes. This raises debt normalization concerns. The middle class views debt as a tool for stability, not a threat. We've been taught good debt. It's said that mortgages are investments, college debts are career bridges, and vehicle loans are monthly utility bills. Data is more gloomy. The average American household has record high credit card debt and 6 or 7-year auto loans. The disparity between median retirement savings and average income is worrisome. Most people use debt to live above their take-home earnings. Instead of assets, they're buying a lifestyle on loan. Credit cards help balance lifestyles between stagnating wages and growing expenditures. The middle class uses debt to look stable, whereas the wealthy use it to buy assets that pay for it. Home ownership as a wealth creator may be the biggest illusion. For decades, the home has symbolized middle class achievement. Although a property can create equity, it is typically an illiquid and pricey asset that many miscalculate. After property taxes, homeowners insurance, maintenance, and the huge interest paid over a 30-year mortgage, the real return on investment is frequently significantly lower than the stock market. The data demonstrates that many households' net worth is mostly in their homes. This causes house rich, cash poor. If you have $500,000 in home equity, but only $5,000 in savings, you're vulnerable. A large medical debt or job loss can cause a crisis. While we don't discourage home ownership, a primary property should be a place to live, not a money generator. Middle-class families often get stranded in their 50s because they rely on one illiquid item, and this brings us to the retirement myth. The standard expectation is that a 401k and a pension will provide a golden sunset, but the reality of the numbers is sobering. When you look at median retirement savings by age, the average 55-year-old has nowhere near enough to sustain their current current lifestyle for 20 more years. They are relying on the market staying perfectly stable and no health crises occurring. Inflation is the silent killer of middle-class retirement. $1 million sounds like a lot, but 40 years from now, its purchasing power will be a fraction of what it is today. Furthermore, the middle class is subject to sequence of returns risk. If the market dips right when they retire, their entire plan evaporates. The middle class is often one bad year or one major market correction away from total financial stress. The system is structured to provide just enough to survive, but not enough to thrive or pass on a legacy. So if the system is structured this way, who actually builds wealth? There is a hidden wealth gap inside the middle class. On one side, you have the earners. These people trade time for money, focus entirely on increasing their salary, and upgrade their lifestyle every time they get a promotion. On the other side, you have the wealth builders. These people might earn the exact same salary, but they behave differently. They buy assets early, often when it's uncomfortable to do so. They keep their fixed expenses low, even as their income rises. They invest before they upgrade their lifestyle. The difference isn't the amount of money coming in, it's where that money goes first. The wealth builders understand the 10 to 15 year compounding gap. They know that a dollar invested in an index fund or a small business at age 25 is worth infinitely more than a dollar spent on a luxury car at age 40. Asset ownership versus a consumption mindset is the ultimate divider. Most people stay trapped for reasons other than laziness or intelligence, social pressure, and lifestyle signaling. As social animals, we are taught to exhibit our status through our purchases. Training the middle class to seek safety and stability might lead to risk aversion. Instead of scaling or owning, they learn to acquire a good job and stay there. Our schools teach fundamental budgeting, not how to hold cash-producing assets. Our upbringing makes us think a paycheck is the only security. True security comes from assets that can pay for your life regardless of whether you work. Middle-class people are taught to survive in the system, not to rise beyond it. To influence the outcome, pull 5 practical levers. Start by aggressively controlling fixed expenses. This involves keeping housing and transportation expenditures within the bank's affordability limit. Second, avoid lifestyle inflation during the first 10 years of your peak earning career. Every raise should go to investments, not a bigger house. Third, buy stocks, real estate, or small businesses early to generate revenue. Fourth, separate your individuality from your job title. What matters is your net worth, not your wage. Finally, add flexibility. Have enough liquid capital to pivot when an opportunity or crisis comes. Be tactical, not simply motivational. It involves analyzing your own data and determining that following the crowd will leave you anxious, overworked, and broke. The middle class doesn't grow rich because the system values stability over ownership. You've been told to follow a route that will keep you productive but not free. The research shows that income-focused people stay stuck while asset-focused people leave. As you examine your finances today, ask yourself, are you building income or assets? If you're ready to break the rules, reassess all your good debt and safe investments. If this video improved your money perspective, comment assets underneath. Please share this with someone who needs to know the data behind the middle class trap if it touched you. Stop surviving and start owning.